Moving on now, the Reserve Bank of India has moved to tighten control over currency markets, directing banks to unwind large dollar positions, a step that could strengthen the rupee sharply when markets open. Now, under the new directive, the Reserve Bank of India has capped banks' net open dollar positions in the domestic market at $100 million per day, effectively limiting speculative bets against the Indian rupee. The move comes after the currency weakened about 4% since the start of the West Asia conflict and is aimed at reducing volatility in the Forex market. Now, this is the first such intervention by the central bank in nearly 15 years. Market experts say large private and foreign banks with active trading desks may be the most impacted, and they will now have to scale back major dollar holdings built through arbitrage between domestic and offshore markets. Another interesting story which has played out since Friday, with the RBI saying that it wants to put that $100 million cap on the net open positions, and many reports out there indicating that this could mean as high as maybe a 4,000 crore rupee loss for banks cumulatively. How strong are those fears, and what does it mean for banking stocks? Because they seem to be in the red. In fact, HDFC, SBI, ICICI Bank all down more than 1% or so in trade. Let's pull up, in fact, the banking stocks, and you've also got Axis Bank, which is down almost 3%, Kotak Bank, which is down about 2.8%. So, A, explain to our viewers what exactly is this $100 million cap that RBI wants to maintain on net open positions as far as banks are concerned, and B, what their positions on these stocks should be.
So you see, banks have a lot more leeway. Corporates have some leeway. Banks have a lot more leeway when it comes to trading the Forex markets. So banks are even allowed to go into the NDF markets and take a position. Corporates also have have greater limits than individuals could have. A year back in April, the RBI did away with individual limits, which means we could go on NSE and trade in USD/INR futures up to 1 million or so, and then beyond that you would have to show that you are a producer or an exporter of goods and services. They removed that limit, which means retail can no more participate in the currency futures in India through the NSE unless you are actually doing trade. So that was one step towards currency management. Now they've moved to the next step. They're saying even the banks now beyond 100 million exposure cannot use their limits, which were earlier much more significant. And so what most banks did is they had a trading book on currency, and they could actually go to the NDF is basically the foreign derivatives market, and even take positions there directly for liquidity reasons in different currency pairs outside of the USD/INR. So they would do a lot of currency trading. Now the RBI is saying that no, bring that liquidity back home, which essentially means they need to sell dollars, and they would get that cash back in the bank. Now that can have a positive liquidity effect also, because when you sell the dollars, you're getting cash back into the bank's books.
Right.
So that shortage of liquidity which was there, the RBI had to keep doing OMOs. That brings back some money, and the amount is being said around $40 billion worth of dollars over the next week or so need to be squared up or brought back through the banking system. So that's a good amount. It will bring currency stability.
Right.
Even if I look at the charts of USD/INR, they were very, very overbought. So there was a case for us to expect a correction, and the news is sort of
that correction has in fact come in, Rohit. In fact, the INR was trading at levels of almost $95 a barrel, 94.8 or something. This morning they have recovered drastically, and I think that positive correction is now reflecting that INR is trading at about 93.69, which is also extremely high, but relatively lower. It's a correction of about 1.3% or so.
I think it will continue. I mean, this is just day one. They've given time for the unwind. I think probably till the 8th or 9th of April, you'll continue to see that dollar unwind.
Right.
And that will, because 40 billion is a large position, and that kind of selling can bring the USD/INR down by a few more rupees, I feel. So that's going to be there. And so, yes, there is some negative impact on banking. But, when we study markets from a news flow perspective, the worst news usually comes at the bottom. So I would usually take this as a one-off hit that, banks will show in the next financial year. And so it may not even be required that they show it immediately.
Right.
But it's good for the currency side, for the macro risk getting off the table, and it does improve liquidity at the bank's end also.